Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So with today's CPI print, we now can take a breather. We are post-Davos, post-FOMC, post-jobs, post-CPI, and well into earnings season. And where do we stand? Well, in pretty good shape. Above potential economic growth, low unemployment, less threatening inflation, double-digit earnings growth, and reduced uncertainty. Still plenty of things to think about, but all in all, a still constructive backdrop in credit. This week, our three things are: 1. Retail sales disconnect. It's normalizing, but not as weak as the latest data suggests. And 2. Labor's lost leverage. More of the economic spoils are going to capital. Is that a bad thing? And 3. Rising hyperscaler issuance. Massive new supply is forcing investors to rethink the status quo. All right, let's dig a bit deeper. Retail sales disconnect. So retail sales hit a wall in December. The almighty U.S. consumer is sputtering. That's what the U.S. Census Bureau says. Its estimate for December, ex autos and gas, came in at 0% growth month-on-month and 3.5% year-on-year. The confusing part of this is that the data does not square up with what other market observers have said. The National Retail Federation, which says its sales calculation is, quote, powered by real, anonymized credit and debit card transaction data, unlike Census Bureau estimates, unquote, says December retail sales, ex autos and gas, grew at 1.3% month-on-month. Bank of America Institute, which measures retail sales similarly to the NRF, said spending grew 0.5% month-on-month in December. Fiserv says retail sales in December showed modest positive growth in the same-store sales and small business sales. Its Spend Trend Sales Index, which is calculated using year-over-year same-store sales, transactions, and ticket size registered through its payment network, jumped 8.5% in December. Now, there seems to be broad consensus that there was substantial pull forward of holiday sales into October and November, as tallies of holiday spending centered around the long-term average of 4%, although it's worth noting that PwC's estimate came in at a downright robust 6.4% for the holiday season. And we would remind that retail sales data is notoriously volatile and subject to revision. In any event, looking ahead, we would expect January sales be muted given the extreme weather conditions, so brace for that. Now, the broader question impacting credit, of course, is have we hit an inflection point where one of the primary engines of U.S. growth, personal consumption, has hit a wall? Well, we've talked for some time now about the economic reliance on the wealthiest households to drive spending. And to that end, PwC data shows holiday spending, again, that's November to mid-December, up 6.4%, was broken down the following ways: 29% growth for households with income greater than $125,000 a year, a 4.2% contraction for middle-income households, that's $40,000 to $125,000, and a 4.1% contraction for low-income households, that's income less than $40,000. Total consumer consumption, that which feeds into the GDP report, which was a robust 3.5% in 2025, is expected to fall in 2026 to 2.1%. That's Bloomberg consensus. So the direction of travel here is definitely slower. And even though that 2.1% would fall below the 20-year average of 2.4%, we wouldn't put that in the hitting a wall category. All right, on to our second thing: labor's lost leverage. Much discussion this week around Greg Ip's column in the Wall Street Journal that made the case that the rewards of economic output are being funneled disproportionately toward capital instead of labor. Capital is defined as businesses, shareholders, and superstar employees. Labor is, of course, your average worker. Mr. Ip elegantly shows this via two data series stretching 40 years. One, corporate profits, and two, labor compensation, both as a percentage of gross domestic income. Over that long time frame, profits have grown from 7% of GDI to 12%, while labor cost has fallen from 58% down to 51%. So what's the point? Well, according to Mr. Ip, the divergence between returns on capital, profits, And labor, wages, helps explain the disconnect between a buoyant economy and pessimistic households. Well, we wouldn't disagree, but what's happening here is not all that profound. It simply reflects, in our opinion, advancements in technology that have steadily, over a long period of time, made the economy more efficient. 40 years ago, roughly 20% of U.S. employment was engaged in manufacturing. Today, it's 8%. Part of that is due, of course, to automation, and part of that is due to globalization, which has driven a shift to a more services oriented economy in the US. Interestingly, demand for services skills drove services wages higher until the sector, too, saw technology replace workers. In both manufacturing and services, automation has worked to dampen wage pressure. And at the risk of stating the blindingly obvious, AI will surely work to reduce the demand for labor, especially those workers with outdated and less relevant skills. And by the way, corporate profits have risen only in part because of automation. We recall a paper written by Michael Smolyansky at the Fed in 2023 that pointed out that over 40% of the real growth in corporate profits from 1989 to 2019 was due to lower interest expenses and corporate tax rates. Those profitability enhancers remain in place while ongoing advances in automation are continuing. So, going forward, we return to a world where inflationary pressure comes into better balance with deflationary pressure, assuming, and we would make this assumption, that globalization is not going away. Needless to say, high profitability and lower inflation are both good for credit. All right, on to our third thing, rising hyperscaler issuance. I don't have to tell you that the hyperscalers have made a mark on the public IG market. Our good friend over at Bloomberg Intelligence, Rob Schiffman, forecasts more than $4 trillion, that's with a T, of AI capex through 2030 from the big five. That, of course, is Amazon, Meta, Microsoft, Oracle, and Alphabet. $750 billion is expected in 2026 alone. Now throw in AI adjacent issuers, Apple, Intel, Nvidia, and you get close to $5 trillion in upcoming capex. So we've said all along that all sources of capital, internal and external, will be used to fund the AI build-out. Concern is rising among investors on two fronts. One, that spread pressure could emerge from AI-related public IG issuance that overwhelms demand that faces single name and/or sector limits on concentrations. And two, that the composition of the index will change, become more tech-heavy, making the index more susceptible to an AI-related blow-up. On point one, a reminder that demand for hyperscaler bonds comes from the deepest part of the corporate bond market. That's global buyers ready to add large liquid deals issued by firms whose products and services are entrenched in our day-to-day, who have strong balance sheets, and who have built formidable competitive moats. We have little doubt that portfolio managers are quickly taking up their single name and sector limits materially to accommodate current and future AI-related issuance. And it's worth noting that recent mega deals have been oversubscribed by multiples, including Alphabet's 100-year bond and Oracle's more storied credit. Buyers know what's coming, and what's getting sold is getting done within market context. On point two, the big five today represent 3.7% of the Bloomberg U.S. Corporate Bond Index. Torsten Slok over at Apollo modeled out the percentage of the IG index the big five would account for in 2029, assuming hyperscalers issue IG debt to fund 20% of their respective capex. That index representation grows to 6.8% of the total index by 2029. And for context, bank and finance issuers have long been the largest industry segment in the index, and they collectively represent 23% of today's index. Given cyclical volatility inherent in the finance sector, we believe many investors welcome the prospects that their bank and finance concentration will be diluted down by hyperscaler issuance. So there you have it, three things in credit. One, retail sales disconnect. A full read of the data suggests we have not hit a wall. Two, labor's lost leverage. Technology is making the corporate sector more efficient. And three, rising hyperscaler issuance. There's plenty of room for investors globally to add. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. Enjoy the holiday weekend, and we'll see you next week.